Have financial advisors and other financial experts been lying to you the entire time about what your average return is? That's what we're going to talk about today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You've been working so hard for your money, and you're now ready for that money to start working harder for you right now. You want that freedom. You want the cash flow today so that you could become work optional, where you work because you want to, not because you have to. How? Because you have enough passive income coming in to pay for your monthly expenses. But more importantly than just doing that and even becoming financially free, it's about creating a life of meaning and legacy. It's about creating a life that has a ripple effect in the lives of others, because as you're blessed financially, you can create a greater ripple effect in the lives of others as well. Thank you for allowing me to create that ripple effect through you. Appreciate you binging. You've been sharing on these episodes. And most importantly, guys, you've been taking action on these things. If you're wondering, like, how can I actually get, better returns? How can I create passive income right now? What's possible in my situation? Check it out, moneyripples.com. There's a passive income calculator. Try it out today to see just what your number could be, because you might be able to have financial freedom faster than you ever thought possible. Try that out at moneyripples.com. All right, so let's talk about something today, because I know that the hardest thing I have to deal with sometimes is all the misinformation out there. And then the hard thing is because it's so popular that everybody just accepts it as truth. Give you an example. I was listening to a financial advisor the other day, and he starts throwing up a quote of Albert Einstein. He's like, hey, Albert Einstein said that compounding interest is the eighth wonder of the world. Those that earn it, and those that don't, pay it, right? And I was like, well, first off, I think he just mixed a little bit of Ben Franklin with a misquote from Einstein, because Albert Einstein, if you look it up, you try to Snopes it or whatever you try to do, never said compounding interest is the eighth wonder of the world. The only place you ever see it is financial advisors' websites or people that try to quote from that. But it's not true. He never said it. He was talking about compounding numbers and mathematics. Had nothing to do with finances, money, or compounding interest. He was talking about a completely different concept that the financial world loved to take and skew it towards you. And I realized this for myself, right? Because when I was a financial advisor, here's another thing that I did that really ties in with this episode today, is that we were talking about rates of return, right? And this product trainer, I guess you could say, he came from a specific financial company. Now, understand that when I was a financial advisor, this was after 9/11. This is right after the 2002, big tank in the stock market that year. It was like 23% loss. And then it was starting to recover again by 2004, 2005. Well, in 2005, this is the year before I quit being a financial advisor, this guy comes to train us. He says, all right, everybody, here's the deal. Okay, let's say you have $100,000. and you lose 50%, what are you left with? We all said $50,000. He's like, right, you guys are math geniuses. All right, but let's just say that now you want to get back to 100,000. What's the rate of return you guys got to get? And we all said 50%, right? He said, wrong. 50% on $50,000 does not make you 50,000 more back to 100,000, does it? It's like, no, 50% of 50,000 is only $25,000. So you're only at 75,000. We're like, what? He's like, and even worse, guys, look at the average return. You lose 50, you make 50, 0% average return, but you actually lost 25%. And all of a sudden, I remember thinking, wait a minute, this doesn't seem right. The math should be this way. And he was trying to teach us this concept because he was trying to show that there's another product that they were offering that wasn't going all the ups and downs of the market, right? It had guarantees on the bottom, and then you get some upside potential too on this annuity, specific annuity that he had. And it kind of threw us for a loop because all of us guessed it wrong, right? And this is when we realized that average returns and actual returns are not the same. They're not at all. And the crazy thing is, like I mentioned, I was listening to Financial Advisors last week. He did the same thing. And he even said, here's the 50 years of the S&P 500. He showed year by year. It kind of looks something like this, even though I'm showing you the 40 year on this one. So you'd see something kind of like this. Now this one shows like 40 and then a little extra, right? But really, like if we're looking through 2024, 40 years is actually 1985 to 2024. So he showed us this very thing. And now his thing was 50 years and is saying instead of 11.2 average, like this one says over 40 years, his was showing over 12%. just saying, hey, the S&P 500 has done 12% since forever, right? And this is where that Ben Stein quote I keep talking about that his father taught him. He was a Harvard economics professor saying that figures don't lie, but liars figure. And so he showed this very thing saying it was over 12%. And he says, if you had $100,000 50 years ago, you invest in the S&P 500, it'd be worth over $17.1 million today. So immediately I went to the calculator and I said, really, what is that? And so I pulled it up and I brought it up, and I'm showing you this guys just from my phone, but I put in the $100,000, right? Oops, you can't even see that. There you go. $100,000, for 50 years. And then I figured it out to get the 17.1 million, right? That was down below there. It was actually 10.84%. So where he was showing over 12% a year for the S&P, the actual average return was 10.84%. Now, how is it possible that he's showing one number saying if you get over 12% on 100,000 after 50 years, you'll have 17.1 million and change. But then I put it in, it was like 17,172,000. So I put in the same thing. It was 10.84. How is that possible? Is the math wrong? Am I doing it wrong? What's happening here? Because everybody keeps telling you it's been this way forever, right? Here's where it is. Here's where the truth is, right? It comes up here. And I'll show you this thing with you right now because this is the average versus actual. So this is showing somebody that had $100,000 initially. You can see that right here, right? $100,000. Oops, don't want to do that. And then the first year they make 50%. Well, if you make 50% on 100,000, you now have 150,000. But what if that next year you lost your 50%? You lose 50% that next year. So you would think if you make 50, you lose 50, you'd think that somehow you'd be fine. But no, this is done in reverse of the example I just gave you, right? Look, you have 75,000. So even though you average 0% those 2 years, still you've lost money. Then, of course, he shows the third year, 150% gain. You're like, whoa, awesome, right? Let's make 150%. And then you lose 50% the next year. Now, if you figure out the average, right? You take all the positive numbers. I know for you guys that hate math, this is not your favorite. But take 150 plus 50, that's 200. Now take the two negative 50s, that's 100, right? So you have 200 minus 100 is 100%. Divided by 4 years gives you an average return of 25%. See the 25% there? But notice, because of how the numbers worked out, your actual average return, or your actual return, this is not the average, the actual return is negative 6.25, which means your average return is about, you don't do it exactly by 4 because it's like a compounding thing, but it's probably going to be like a negative 1.2, 1.25, 1.5%, something like that. So you have about a negative 1% plus is the average loss per year, yet the average return shows 25%. If you were a financial advisor, which return would you rather show? Knowing that both of these are technically true, which one would you rather show? Obviously 25%, right? This is what I realized. And this is what a lot of us in the same financial advisor office realized too. We started looking at 1995 to 2005. We said, wait a minute, if we would have even got all the stock market gains, even we were capped on some of our gains, but just never lost money, even though we had the roaring 90s that made so much money during that period of time, and then we had some down years, about three down years, and then a couple more up years, still we would have had more money had we not lost money than if we just rode the stock market up and down, right? Because again, we realize this. We're like, wait a minute, that's true. This is the problem we keep running into. So I looked at the last 40 years. I looked at the stock market. I said, all right, let's look at this. 1985, 40 years, right? We can see here that if I go on this line, opening, let me move it, 167.2 is the opening on January 1st of 1985. So 167.2. And I see that because it's in the upper corner there. So that's where the market started. Now, if we went to the end of 2024, the close, which is basically the open of the next year, the close of December 2024 was 58.81. Now, if I were to put the same numbers in there, remember, I've seen 40-year returns, just like this one right here. This 40-year return says 11.2% over the last 40 years. That's got to be right? Because we had a huge up year, really two up years, 2023, 2024, massive up years. Look, only got one down year there. Now, I'll also tell you, this depends on what month, because 2018 was not negative 4.4 if we went from January to January. This was taken on certain months. They don't say which ones, but I'll tell you that 2018 was pretty much a flat year, not a down year. Regardless, right? Just so you know, really, 2008 was the last negative year that we saw in the S&P from January to December, until we had 2022, and it was only 1 year. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. Either way, still says 11.2% over the last 40 years. Well, what's 11.2% on that 167, right? So I put that 167.2, but guess what? To get to that same 58, 80, whatever it was, right, at the end of the year, it wasn't 11.2, it was 9.31. So the actual return is actually 9.3. And if I would have done 11.2, right, guess what the SP should have been? Should have been 11,679. We're not even close to that. That's more than double where we are right now. More than double, right? That's how much just a few percent being off can really mess with your head. So what did I say that was? 9.33? I can't remember now. It was somewhere around there. Oh, it was less than that. It was 2.3. Either way, yeah, whatever it was around 9.9 a quarter, 9.3, something like that. Yeah, there we go. It was about 9.3. So in any case, we've seen about a 9.3% actual average return of the stock market. That's over 40 years. That's not even the last 30 years. You guys have seen me show that about 8%, especially lately. Now, let me show you this. What if I went from April to April, right? April. So April 1st to about mid-April right now. So if we're going April of 1985 to April now of 2025, guess what? It's less because why? Stock market is, as of the 14th, 54.05, right? That's where it closed on April 14th. Well, look at this. 154, I put 09. Now it started at 180.66 in April of 1985. Look, it's 8.87. So now it's almost a 0.5% less on average. All I had to do is move it over 4 months. That's it. I just had to move the numbers over 4 months and look at the drastic difference. Now, of course, the market did come down. That did change it. That's why we see 8.03% for really the last 30 years, when it used to be, when I was showing you guys, like 8.74%, just right around the end of 2024, beginning of 2025. So as you can tell, these numbers keep fluctuating. But here's the important thing. These numbers are not 11 or 12% as they've always been promising, are they? No, the actual returns have not been that much. This is why I started looking at the actual stock market. I stopped looking at the little Instagram, Pinterest-worthy things that show the S&P 500 ups and downs and all that kind of stuff. And they still make it look amazing. It's like, look at the average return. But remember, every financial advisor, including myself back in the day, I would put those average returns in the calculator. Remember what the S&P 500 should have been? It should have been over 11,000 on the index. It did top over 6,000 at one point, but now it's down around, like I said, 5,400, right? So it's now less than half of what those returns would have made me expect if I was at 11%. This is why you see so many people, especially in the financial industry that's been around a while, will just use normal 8%. They'll use 8% because they know for a fact that's more like real life. But what we're always taught by financial advisors, and even like Dave Ramsey, who says it's always 12% and average that way since 2000 BC, that's what you should use as a number. So if he's saying pull out 8%, but guess what? The market only averages 8%. Guess what? You're running out of money. You're going to run out of money pretty fast, right? He's thinking you'll be fine. But the truth is you're not going to make that because of those negative years. Once you have now, I even show you what happens when you start pulling out money with a negative year. I did show that on an episode last year. Now, if you start to what I call disinvest, right, where you start to pull out money and you lose. Imagine this. Imagine that you have $1 million. You think you're going to make 10% a year average return. So you think I can live on $100,000 a year. Well, what if you did pull out that say before you pull out that $100,000, that million, all of a sudden the market drops 20%. Now you're down to $800,000. You pull out your $100,000 because you're saying, well, that's what I needed to have. I'm sure it'll come back in average, right? If you pull out $100,000, you're now down to $700,000. Now, if you go from $700,000 now to the $1.1 million that you need that next year, you need $400,000. You don't want a 20% return to break even. Or even if you said, well, I lost 20, so really I need 40 to make up for it, right? That's what we might think. Well, 40% on 700,000 is $280,000. So you get up to 980,000. That's less than even the million or 1.1 million you needed. You pull out that money, now you're down to 880,000. Now, let's say the market does 10% the next year. Well, cool. Well, 880,000 plus 88,000, right, is going to put you in the ballpark about 978,000. So now it's just a little bit less. You pull out 100,000, now you're down to 878,000. But what if all of a sudden the market drops, say 20% again, right? Drops 20%. Well, now you have the 878,000, you lose 20%. And now I'm literally just doing this all on top of my head. I know I'm way off here, but that's going to be somewhere in the loss. You're going to lose right around 100 and, well, actually about 170 some odd thousand there. So let's just say 178,000, right? Now you're down to 700,000 again, right? And and then of course you're down to 700,000, but then you pull out 100 grand, boom, it's gone. Sorry, you're not 700,000, 800,000, pull out 100,000, now you're down to 700,000. See the problem? Like you keep losing that money. You just have a few bad years. You pull out that money, and the next thing you know, that this money just keeps dwindling down. Again, I could have probably created something for you guys visually to do that, but you see my point is that when it comes to real life, this is where financial advisors lack. This is where the financial industry lacks. They keep throwing you all these hypothetical numbers, but yet your reality is not the same. We're not even talking about taking out costs of the mutual funds that you're in and everything else. We're just talking about getting the SP 500 returns. By the way, if you have an SP 500 fund, you're still going to have some fees coming out. There's still going to be some admin fees. Even if they're small, they're still coming out, affecting your return, meaning you make less than you thought you'd get. This is my problem every single time. It's never just simple math, is it? It's so confusing. And how do you even know that you're going to be doing the right things? This is where it comes in. This is where you got to protect yourself. This is where you got to make sure you're doing what's right for you. This is why I love doing things with real estate. That's why I love it. I lend my money, I make 10%. I know I'm making 10%. Is it guaranteed? No, of course not. But neither is the stock market. And so many people are out there gambling with higher risk investments using stocks that have no real tangible value. They're all based on what people value it. Think of it, Nvidia. Nvidia had the AI tech boom. Everybody thought it was amazing. And now they're like, nah, never mind. Not that cool. And so it comes crashing down. Was it ever real? Was gains ever real? Same with Tesla. We saw it skyrocket, then it tanked. Was it ever real? Were those gains ever real? No, they weren't. They weren't real life. Getting cash in your pocket is real life. Numbers on a computer screen, not real. Not until that's in your pocket, not until it's yours. Yeah, again, you can make that same argument in certain aspects of real estate too. I get that. But what I have noticed over time is that I worry a lot less about that. I don't worry about tariffs because guess what? I don't worry about 10% drops in a couple of days and then maybe a 10% increase one day and then it drops again the next. I don't have to worry about that psycho ex-girlfriend, right? Called the stock market. I don't have to worry about that bipolar nature of investing. I'm in something that's more stable. I like investing in my business and I like investing in real estate. Dave Ramsey invested in business and invested in real estate and got to be worth hundreds of millions of dollars. He did not do that by saving and slaving away into his mutual funds. That's not reality. Financial advisors, same thing. Often when you see how if they ever say, hey, I'm financially free. I had one financial advisor say that. He's like, I didn't do it by the time I was 39, Chris, like you did. I did it by the time I was 50. Well, what did he do? He went into dividend paying stocks, which are very few stocks nowadays, like Procter and Gamble and stuff. He goes into those getting paid 5% a year. Well, if let's just say he's a 100,000 a year lifestyle, that means he had to have at least $2 million, right? To live on that kind of amount. So $2 million, cool. You can live on a 100,000 a year lifestyle. The real question is this: did he do that by just, saving $500 a month? No. The guy made a killing selling you financial advice, selling you on the dream. And then all the money he made, he was then able to pack away and save away. And then finally, after like 25 years of being in the business, he finally was able to have enough to quote unquote retire, right? Now, I'll tell you this firsthand. Being a financial advisor was probably the best financial investment I had as a financial advisor. It wasn't the mutual funds. It was being a financial advisor where I was selling people stuff. Because even if they lost money, I didn't as a financial advisor. I still made money whether they made any money or not. The question is, do you think that's right? Personally, I didn't. I didn't feel it was right that the best investment possible was becoming a financial advisor, not investing with a financial advisor. That to me was wrong. The fact that they can get paid whether you make money or not, they're the only ones that don't lose. That's low risk, high returns. That is how I would invest. That's how I do invest now. I look for the lower risk as possible to get the highest returns possible. I minimize and control my risks so I can get a higher return of my money and on my money. I hope that makes sense. I know I'm going into depth even more than I was planning to, but just so you know, average and actual returns are not the same. Do not believe for 1 second that you're getting true statements. Even if it is true about the average, it doesn't mean that that's the money you're going to make when you put it into a calculator. That's where financial advisors go wrong. Your life was never meant to be put in a calculator, and the numbers never add up anyways. This is why people get so disappointed, and they literally change financial advisors every 3 to 5 years on average, hoping somebody will do something different, yet they keep doing the same thing over and over, teaching the same stuff. Just so you guys know, I do master classes and I'll talk about these myths and stuff, even like on this podcast. You know what's crazy? That same financial advisor, he actually presented after I went up. He didn't see my presentation. What's cool is that he starts talking about those same lies, those same myths, like they were gospel, like they were true. And the cool thing is the people in the audience were looking at him, looking at me, looking at him. They're like, all the lies that Chris just mentioned that made perfect logical sense. This guy's now saying it. And this guy's been teaching it for decades. He's like, I've been in this business now for over 30 years, and this is what works. And all the rest of people said, bull. The question is, at what point do you call bull on this and then do something different? So it's up to you, right? You can keep doing the same thing everybody's done and keep getting the same old cruddy results, or you can do something different that still tens of millions of us have done and got in better results. That choice is up for you to make. I'm not here to tell you what to do for your investments because that's your choice. That's your freedom to do so. But I'll tell you, there are better ways to do this. If you want to know more, you can always go to moneyripples.com. But in the meantime, I want you to go and make it a wonderful and prosperous week and stop buying into the lies that have been taught to you for so many years. Open your eyes, question everything, even me, and that's where your freedom can happen. Go and make it a wonderful day.